All right, welcome to Finance Friday, our weekly wealth creation course. I'm Jerry Fetta, owner, founder, CEO of Wealth Dynamics, and I am joined here by my co-host and fellow hat wearer, Neno Aquino. What's up, Nano?
Hey, what's going on, Jerry? Good to be here.
Hey, good to be here with everyone tonight. So we're going to be going over an awesome course. We're going to talk about how to turn your house into passive income, right? This is a topic we've covered before. We're going to cover it once again. Now, before I get started, I want to introduce two of our staff members in the comments here. We have Kevin Peck, okay, and we have Griffin Henderson. So they're both here in the chat. So expect a message from Kevin and from Griffin. Their job, their role here tonight is connect with you, answer your questions. And if you're not a client yet, or if maybe you've bought a book before, you've got a course, you're ready to move forward with your next steps. They want to jump on a call with you and answer your questions and help you out. So be sure to check your chat if you get a message from them. That's who that is. That's what their goal is. But tonight, we also will be talking about the first position home equity line of credit. This is part of the strategy and the blueprint of financial freedom. And so some of this will be from the book. We're going to cover some of this in depth tonight. We've gone over this before. We're not going to get super nerdy into the math. I want to stay high level concept with this. Because everyone's numbers are going to be a little bit different. So as you're learning about this strategy and you're ready to learn more specifically about your situation, there are ways to look at what are the numbers for me? What is my math going to look like? How does this work for my financial picture? Right now, before we get started, we always cover some house rules. Nano, do you want to cover those?
Of course. So a couple of things, right? So as you joining here, so a few people that are going to be on the webinar, first time people, right? Welcome. Could be also, you could be a long-term client, also welcome. And then maybe just, you have been seeing us for a few weeks and you're not yet a client. Now, as we start every single week, number one thing to have it in mind, regardless of where you are in the spectrum, is have a purpose for attending the meeting. Okay, what is the purpose for you to be here tonight, right? For the majority of our clients, like we have been through this a few times, so you already know, like the majority of them is going to be having in mind, okay, the goal is like to continue to learn, to expand, that at least going to lead into something to be applied so I can better improve my finances that's going to lead to financial freedom. So for you, what is the purpose, right? Friday night, you could be doing anything. Why am I here? Now, why is that important? Because it's going to actually put me at cause, allow me to be more responsible to why I'm doing this. Okay, so it's like, let's have that very clear. So you're just not like wandering around. And so you can actually get something out of this for yourself as well. So you can also get value, right? Like we're putting in the time, we have put in the research, everything together for you, but let's put some skin in the game, right? Let's have like a purpose for attending here. Also, look for ways to apply the information. And we do realize, right, that there's going to be a lot of content, might be like new terms, terminology. We're going to try to keep it as simple as possible. We're going to be opening up for questions here throughout the webinar to help you better understand this. Keep it in mind that if the ideal scenario is like, if you see enough information that this does make enough sense for you, that you like to have a conversation to be ongoing, maybe get a book, right? We actually can get a book here. The book's free, just pay for the shipping or the handling. And then we have Kevin here on the chat, along with Griffin, that will be reaching out to you for help. Now, let's say if you are a client, right? Maybe you have been a client here for a little bit of time and you haven't taken a whole lot of action. That, okay, the thing is that you do know that you need to do it, you haven't done it. Not a problem. Hey, let's time to get back on the horse, right? The last thing here, like almost the last thing here, be a producer and not a consumer, in the sense, okay, let's not only look for information that we can be applicable, let's find ways, right? Okay, good. If this is for me, fantastic. If this is not for me, then move right along. And last thing here is share if this helps you. Whether you're a client, whether, this is your first time, it kind of goes back to the purpose. Why am I doing this to begin with? It's that I'm going to be sharing this from a personal experience. In order for me to build wealth, I really had to become unselfish, right? Which kind of goes back to sharing, like having a higher level of responsibility. Like if I want to be able to expand, to grow, and be able to really have the things that I want, I really got to be like, put the things that I want mostly for myself aside momentarily in order to help more people so they can actually exchange with me. So bottom line is share if this helps you. Could be maybe introduce somebody here to us, maybe share this book with a friend, a co-worker, or a family member. or just sharing on Facebook or, within your social media group.
Exactly. So we're going to talk tonight about the first position home equity line of credit. And this is something that if you're a client, you've probably heard about before. This could also be something that you've never heard of before, right? This is a brand new concept. And then this might be something that you think you know about, right? This is a concept that often gets confused with other things. And so there's this thing of, isn't that risky? Isn't that this? Isn't that that? We're going to clear all that up tonight. Okay. So the bottom line is, the average person that owns a home, it's always only ever going to be an expense. Okay. Sure, it might appreciate. And when I say might, it will, like if you hold it long enough, it's going to go up. But the entire time you hang on to it, it's costing you money. Right. It's not very much different than the idea that I'm going to buy some crypto that, it's never going to pay me anything. And I'm going to pay fees maybe to hold it. And then hopefully I can sell it for more one day. Right. Or if I were to buy gold, right? We tell you buy gold. Well, we don't say leave it in storage forever. We say borrow against it and turn it into passive income. Why? Because you don't want to just hang on to a rock that has storage fees forever. Right. So when you're doing this with your home, like, sure, you can have appreciation, but the home has to be looked at differently. It can't be looked at as an asset. Okay. And for the average person, the home is only ever going to be an expense. They're going to pay the bank. They're going to pay the utility company. They're going to pay, their title, their insurance, their escrow, the whole 9 yards. And so we're going to talk tonight about, well, how do you make that your own personal bank? Just like we do with life insurance, just like we do with gold and silver, right? So I'm going to jump into our slides here. Let me share my screen here in just a second and we'll get into this. Okay, this is one of my favorite strategies. So this is how to turn your house into a passive income generating personal bank by using the first position home equity line of credit. Now, before we get into it, I want to clear up a couple of terms. Okay, first term is, what is a home equity line of credit? Nano, do you want to clear this up for everybody just on the definition here?
For sure. So what is a HELOC, right? HELOC stands for home equity line of credit, and lines of credit are secured against the value of your home equity. So lenders may be willing to offer rates that are lower than they do for most other types of personal loans. That's from Investopedia. Now, whenever we actually do a comparison against the conventional mortgage, right? We may hear something as far as like, oh, this may be quote unquote risky. And one of the things that you may encounter here with us that we're very big with definitions. So sure enough, I looked that up, right? What is the definition of risky? Now, risky, whenever on the dictionary, means full of the possibility of danger, failure, or loss. Now, if something it is risky, if it has that possibility of full, failure or loss, how come, right? Now, when we go into life, right, just about everything is risky, especially if I don't know what I'm doing. So in order for me to actually lessen the risk, who would be like, if I don't know what I'm doing, I would be the most risky individual particle in this scenario. Did you have something to say, Jerry?
Yeah, and I was gonna say, knowing how something works is different than being familiar with it, right? So like me and Nano, we talk to people about this, like, for example, like on banks and retirement accounts, people are familiar with them. They're used to putting money in them. So it's like, oh, I put my money in my 401k. It's like, yeah, but you don't understand it. You don't know what the mutual fund holds and how the shares work and what the balances are in the companies and all this different stuff. You don't know that stuff. Like, you don't have knowledge. You're just familiar with it. Right. And so someone like Nano's saying, someone might look at a HELOC, a home equity line of credit. It's different. It's unfamiliar. They're familiar with a conventional mortgage. And so they're going to look at the HELOC and say, oh, that's risky. Okay, well, the thing is, they don't actually know how their mortgage works. They don't understand the amortization schedule. They don't understand that every time they refinance, they're resetting the interest back to zero. They don't understand, the reason that it's structured the way it's structured, right? So knowledge is something that you have to look at as knowledge, not I've just seen this thing before, or I've known plenty of people that have done it before. Okay, so the next thing I want to cover here is, what is first position? So this is regarding debt, right? So first position, you have first or senior. So we're talking here about mortgages, okay? So basically, like, let's say that you have a house, okay? So you've got your home and you have a mortgage backing that home, right? Directly secured by the title of the home, right? That's first position. Like, you go to the bank, you get a mortgage. Now, let's say that that you have a little bit of equity in this home. And so you take out a second mortgage, right? So that you've got another note now secured by your home. Okay. This guy is now second position. Now, if you were to default, who gets the home? First position, right? So we're saying that this is the primary debt on the house. There's not other debt after it. Okay. It's kind of like, you know, if I were to borrow money from Nano, and then he found out that I borrowed money from him. But before I borrowed money from him, I also went to Kevin on my team and borrowed money for him from the same thing. Nano would be a little bit worried. He'd be like, wait, you borrowed $1,000 from Kevin for this thing, and now you're telling me you need to borrow $1,000 too. Where's the collateral? You already posted it to Kevin, right? So first position means you're a senior, right? So this definition, first or senior mortgage would be considered preferred debt when comparing first and position mortgage. This form of debt obligation typically has to be paid first because it carries more significance than other types of debt. It's literally the first one in line. Because they're the first one in line, they've got more priority, they've got, you know, more rights. Okay. Interest on preferred debt is typically free from any taxes. We won't get into that because this is, you know, a little bit off into the weeds. But this part of the definition from here up is what we're going to focus on, right? So the first thing on this is there's a difference between first position and second position. We're talking tonight only about first position home equity line of credit. Okay, which means it is the primary debt on the property. You do not have another mortgage. Okay, we call it with our clients, we call it replacing your mortgage. Instead of a mortgage, you're going to have a line of credit. Okay. Now, the other thing we've got to understand is what is a line of credit? Nano, we've talked about like one-way and two-way debt where you can put money in, pull it out versus debt where you can only put money in and you can't take it out. Do you want to break that down with people on like line of credit versus like a regular loan?
Of course. Now, so whenever I have a line of credit, right, I almost have to kind of backtrack a little bit so the individual would be able to see the advantage of doing that. Because if I have a loan that I'm putting money into, I don't have my wallet here nearby. I usually have it so to kind of show people the cash, right? Like, so let's say I'm putting money inside of a loan that I'm paying it off, right? Like let's say a regular mortgage. That money is going there, right? It's depending where I'm at, right? Let's just say the principal is going down eventually after the first 7 years, right? At least the majority of it. So the money's stuck. Now, if I understand this, okay, but the quote unquote appreciation is going up. But that money, it is literally considered dead money. When we even look at the definition of the word mortgage, right? Again, very big with definition of words, it means a death pledge. I think about this, right?
Could you say that again, Nano?
The definition of the word mortgage means a death pledge. Literally, it's like I'm pledging to die, right? It's like money that's going to a mortgage, literally is going to be stuck there, and I really can't do anything until I either sell it, right? Or I get rid of the house. Now, if I'm going to be putting this money into a line of credit, right? Now it allows me to actually take it out and use it as I see fit. Now you may ask, well, it's going to cost me to take the money out. But here's the thing. There's a cost to everything, right? There's a cost to money being like sitting dead, like a static, right? Which is caused to inflation. If my money is being dead, there's also the opportunity cost where I could be using this money elsewhere to be making a higher percentage, which is, a little bit of the strategy here that we're eventually going to be diving into, but at least I want to give you the breakdown. Okay, one, it is dead money. So I'm not really going to be able to do anything there. The second one is, okay, I have money that's here and it's fluid. I'm allowed to take it out and put it to work elsewhere. And by being able to put it to work elsewhere, it allows me to do something that is called arbitrage, meaning I'm going to be earning on the spread. So let's say it costs me 4% to take money from this area. Now I'm putting money that I'm going to be earning, let's say 8%. I have a 4% spread of a positive, right? The money is no longer dead. And now I'm earning 4% on this. So this will be like the major difference between both of these.
Yeah, and I just drew this out, right? So this is a line of credit is a two-way loan, meaning you can put money into it, you can take money out. We're all familiar with this through the mechanics of a credit card. When you pay your credit card down, what can you do? You can pull it right back out again. right? You can charge, pay down, charge, pay down. Now, this is different than a car, right? With a car, you make a payment on your car, you can't have that money back. Same thing with a mortgage. You make a payment on your mortgage, you can't have that money back. Okay. So really quickly, guys, this is again from my book, Blueprint to Financial Freedom. If you've not gotten a copy of this, reach out to Kevin. Okay. You can right now get the ebook for this for $2.99. You can get the regular book. It's free, $10 for shipping. We'll send it out to you. But this is breaking down the mortgage, right? So I want you to just think with this concept. This is on page 53 of Blueprint to Financial Freedom. Okay. So this is on page 53. Neno went over the death pledge, right? But it says, so think of the mechanics, right? So you're borrowing from the bank, right? The bank doesn't actually have money of its own. They have other people's deposits, including yours. So you and your community deposit money into the bank. The bank then takes money that is not even rightfully the bank's and loans it to you for a mortgage. We talked a little bit about this last week. Let's be very clear. This is your own money and other people's money being loaned to you. So the bank didn't have money in the first place, but loaned you money that wasn't theirs and effectively doesn't exist because it's still due back to the depositor upon withdrawal. So what did the bank loan you? They loaned you digits. Okay. Digits on a screen, not money, not anything real and not anything they're at risk for. Here's the thing, guys. When you're looking at a mortgage, what's the idea? Oh, pay the house off, pay. Why? You're giving the bank back money. They're not putting anything at risk. This is other people's deposits. Those people are going to get their deposits anyway. So why are we trying to pay the bank back? Neno, you were going to say something?
Yeah, no, just like this. There's I was going over this week some content, right, for tonight's webinar. Like, and we may have this romanticized idea about, let me go ahead and be debt free. Like, if I'm debt free, that does not equate to me becoming financially free. Mm-hmm. Right. And it's almost like understanding like the purpose. What is my goal? Because I don't know if how it is in the white culture, right? But Latino culture is a very big thing. That's like, oh, the guy or the son or it's like we need to provide for the mom. To be able to dream is to give your mom a house. Like, so it's a very real thing, right? And then as I was, going through this many years ago, right, I'm like, okay, what am I really trying to accomplish? Am I really trying to? So first of all, there's this idea. I don't know where it even comes from, but I just know there's there. And we have them, right? We just like, when was the last time that we have inspected? And is it actually useful? So I'm just have this idea that I grew up, okay, I got to give my mom a house and this, or I may have this idea like, I got to buy a house. I got to buy a house. And I'm like, and it's like a good intention, but from a mathematical standpoint, what makes the most sense? Right? So when I look at that, right, okay, am I going to be more beneficial? Is it going to be more beneficial for me to, quote unquote, be able to give my mom a house? Or is it going to be more beneficial for me to do things in a little different way where I become more knowledgeable, that I allow to have myself a home equity line of credit to pull money out, that now this investment now is earning passive income. So think about this. If I were to die tomorrow, right? Or eventually I'm going to die. Let's say I'm going to die before my parents, for this example, knock on wood, right? Let's hope that doesn't happen. But let's just say for this scenario, right? Good. So, and if I'm in a position where I have investments, now they're going to be, let's say I die. Now, could I have a house that I gave it to my mom, or would it be better if I have investments that now replace my income to take care of my family? I much rather go with the investments. It's a way higher level of responsibility than giving my parents a house. So anyway, so just like having the proper mindset, because if I have the wrong viewpoint on this, right? If I have like, hey, I want to be able to give them a house, I want to give them a house, I want to buy a house. Okay, great, right? But what do I really want? And this is not like to invalidate you, because it's a very good thing. Like, it's very like, I was coming from a place of duty, like it's my duty to take care of my family. So it's like something to be admired. But at the end of the day, like I also got to be logical, right? Okay, good. My intent is to take care of my family. What is going to be the best routes? Because I could be operating with something that could be a false data, meaning almost like if I have a calculator, right? I try to apply 2 + 2 being equal 5. That doesn't work. It gives me the incorrect result. If I want to give them a house, but it is a burden, I'm not actually helping them. Which at the end of the day, if I'm doing this in the wrong sequence, right? If I'm using a bank, a financial institution, as Jerry just said, that is creating money out of thin air, using my money and your money, right, that we deposit there and charging us back interest, the ones that don't have our best interest in mind, and also understand this is a financial trap, right? Very easy to get into. 3% down, hey, super easy, right? And then we're trying to show the opposite, which would be a HELOC. Hey, let's study a little bit. Let's make sure that we are solvent. Let's make sure that we have 6 months of it. I don't want that. I want the house. What do I want? Do I want something that's going to be easy access that I can get into so I can actually be able to say, hey, I got my mama house? Or do I want to be able to put myself in a position to have a higher level of responsibility to say, hey, you know what? If I die tomorrow, they're taken care of. So anyway, so that's what I had to say.
Yeah, I'm glad you got that off your chest, Neno. That was really good. So we had a couple comments come in. So guys, again, if you're on Zoom, if you have questions as you're watching this, drop your questions in the chat. Neno and I will go live with you. Nicholas Bracey says banks lend you your and other people's money and then charges you and other people interest on your own money. What a scam. Avery DeWitt says fraction reserve banking. That's exactly what's at work here. We've got a comment from Andrew Davis on Facebook. He says HELOCs are one of my favorite financial topics since I learned about it here last year. So many interesting things you can do with them. So guys, here's the myth on this, right? So the myth, like Nano covered at first, is people say HELOCs are risky, right? What's risky is being insolvent. What's risky is being illiterate. What's risky is not having abundance. What's risky is having a 30-year or longer. It's going to be longer because you're going to keep selling the house every 7 to 10 years. You will have it till you die. That's risky, right? So risk is defined as, you know, something that I don't control that could put me in danger. If I increase my knowledge, I don't have that, right? Like you could say drinking water is risky. You could say the stock market's risky, okay? And anybody, I'm going to go ahead and get this off my chest. Anybody that even touched crypto in the last, you know, the last 10 years since it's existed, I don't want to hear a damn word from you about how risky it is. Okay. Like if you're doing that crap, like a HELOC isn't risky. You're literally buying invisible digital trinkets, right? And they drop 75% of value like that. So risk is all relative. We've got to look at that. Now, the other myth here is that a conventional mortgage is the way to go, right? People think conventional. We kind of talked about this. Let me just give you guys the math on this really quick. I have this in my book, again, Blueprints of Financial Freedom. This is on page 57, right? So again, if you don't have this, reach out to Kevin. If Kevin sent you a message, by the way, check your chat. Okay, Kevin's trying to connect with you for a call. Kevin is very helpful. He'll answer your questions. If you saw his message, don't be that weird person that acts like you didn't see it. We all know you saw it. Just send him a response back. He's a good guy. But here's the thing. So this is a 30-year mortgage, right? So we're looking at the same house here. This is I believe a $300,000 home. Yeah, $300,000 home, right? So we have 300K on one side. And then we have 300K on the other side. Okay, this is conventional. This one is going to be a HELOC. All right. So here's the math on this. So we're looking at a family is making $8,000 a month. Okay. On the conventional mortgage, I know that looks like it's ancient cave writing, but it does say conventional. I promise. So on the conventional mortgage, they're, you know, financing their home $300,000. And then on this side, they're doing the HELOC, right? So they're financing their home $300,000 as well. On the conventional mortgage, they're making their average monthly payment, right? So their average monthly payment on this comes out to, I think, $1,600 a month is what this is. Okay, so they're making a payment of $1,600 a month on this side. Okay, on this side, they're taking this $8,000, they're depositing all of this into their HELOC. Okay, we're gonna go over the mechanics of this. It's like a checking account. You deposit all of it. Why? Because you can pull it back out again. You would never do this on a conventional mortgage. You would not take your entire income for the month and then pay it on your mortgage because you couldn't have the money back. Right? That's gone. That's done. The bank's keeping that out. On the HELOC, you can pull it right back out. It's no different than your checking account. Right? The result of just doing this instead of this, HELOC depositing, you know, and then using that as your checking account. Not even talking about investing. We're just talking about depositing into the HELOC. This guy pays off in 8.6 years. Okay. His average monthly payment throughout this time is $439 a month for his house. So that's his mortgage payment. He's only paid $45,000 in interest. right? Now on the conventional mortgage, let's take a look at this. He's making his monthly payment just like is normal to do. You make your amortized payment, your principal, interest, taxes, and insurance. Okay, so this guy, he's going to be out in 30 years because it's a 30-year mortgage, right? So he's going to be in debt for basically 22 years more, 21 and a half years more than this other guy. Okay, his minimum monthly payment is going to be, just P&I is going to be 1432. So this is actually 1432, not 1600. So he's paying 1432 a month. And then he's going to pay, check this out, $215,000 in interest. 215,000. He paid 300 for the house. He's going to pay $213,000 in interest. He paid for the home basically twice. Okay. Now here's the problem. On an amortized loan, your principal increases every payment. The interest goes down, the principal goes up. How many people do you know that actually pay a house off 30 years, they stay in one home? Literally nobody. They sell every 7 to 10 years. So every 7 to 10 years, they reset their amortization. They're back at square one where their payment mostly is represented by interest and very little principal. So in reality, if he's doing the average thing that the average person does, he's paying more interest probably than he actually ever gets in house. Because every single time he resets and he's paying more interest because it resets, right? Over here, he could sell and he could change in another house and do the same exact strategy and the math wouldn't be that different. Okay. So that's the hard facts on this. The other one, people say a home is already an asset, right? The idea that we pay the house off, you know, what if real estate crashes? This is the big myth, is a lot of people are confused on what a first position HELOC is. And they're like, well, isn't that what happened in 2008? Isn't that what people did to get in trouble? Now, here's the facts on this. Nano, do you want to jump in and drop some facts here?
Okay, for sure. So one, right, it's the HELOC. It is actually a less risky asset on a bank balance sheet than a mortgage. So Jared just went over some of the numbers here. Now, when we take a look at, go ahead.
And real quick, here's one of the reasons why that is. Like, Nano, if you're a bank, would you rather have a loan on a home where the borrower put down 3% and you've got 97% of the debt extended? Or would you rather have a home on your balance sheet where the borrower put down 80 or 20% and you've only got to extend 80% on the asset?
20%.
Okay, so if the recession comes in and the economy gets bad, which one are you more likely to foreclose on or ask for the money back on?
Squeeze it out the ones that can't really defend for themselves, right? Like almost like in a predatory way.
The little guys. It's going to be the guy that did the FHA loan or the conventional loan. So this is one of the reasons why, right? A lot of HELOCs are also done by smaller banks. There's not a lot of national players that do HELOCs. So these are regional and local banks that are doing these HELOCs, and they're not doing fractional reserve lending to the extent that, you know, JP Morgan is doing or some of these other guys. So they're actually, it's their own money that they're lending out. So because of that, they're going to look at it a lot closer and they're going to underwrite it a lot stricter. And they're going to go with the guy that owes less. That's the person that they're going to give more leniency to. So sorry to interrupt, but continue.
No, you're good. You're good. No, that was good. So like on another note, right? Like as far as you said, what you said right now, pushing the little guy, we also got to take a look at some of the facts, right? In order for me to be able to understand like the history going on today. So what happened, right? Like in 1933, right? Around like we had after the Great Depression, we have the Securities Exchange Commission coming into play. Then now, in order to protect the little guy, we're now going to have all this regulation, right? So just for us to be keeping in track, who are we dealing with, right? All this, again, going back to having a regular mortgage, right? These same individuals, they have been causing trouble for the past, almost close to 100 years now? And I got to understand some of the history here, right? And it's not like, if I just look at the numbers, if I see who I'm dealing with, why am I going to try to do business with them to begin with? If I know, then they don't have my best interest in mind, right? And so when we just look at that, okay, the different types, right, of numbers wise, Jared just broke it down here. On a conventional mortgage, on the 30 years, I'll be paying over 200 grand in interest. Which one is risky?
Doesn't make sense,
right? Like which one has the most danger, right? It's just like, I mean, no brainer. Now, the second thing here, the second fact is the conventional mortgage are more expensive and one-way loans, right? That's the fact, right? We just went over the numbers here. Third thing here, by SEC definition, the Securities Exchange Commission, a home is not an asset on your net worth, right? These are the same people, same institution that came along like, hey, we need to protect the little guy. We got to protect you. And by the way, right, you know, your your home is not going to count in your favor, right? Good. This is not what we think. That's like the rules that we're forced to play, right?
Those same people also protected the Indians when we came here to America.
Exactly.
Just
right?
saying.
Exactly. So, and paying off the house is like never borrowing against your life insurance. So if I'm going to be using my life insurance, now granted that we got to be using a high early cash value, dividend paying whole life insurance policy, AKA your sacred account, right? It is the equivalent of me being to put money there and not never touch it, right? I got to use this tool into my leverage so it can actually break out of the trap.
Mm-hmm.
Again, like this is the financial, like what are we trying to do? It goes back to the purpose. I got to have that very clear. Like I want to become financially free, right? Which kind of begs the question, if I'm not financially free, what am I? Right now, we got to be able to backtrack this. Now we're going to be doing this in gradients in like, okay, now let's say that I am in a position where I'm debt free. That's the level of financial freedom. If I am like, now I'm able to finance my own vehicle, so on and so forth, right? But the bottom line is paying off a house is like never borrowing against your life insurance. I have something that can be used to help me break out of the trap, break out of, you know, the rat race that I'm running in, and I don't use it. Here's the key to the cell. Let me toss it back there. Why?
Let it collect dust.
He like, why? And let me pretend like, you know, like, oh, I can't really use it. That's the key. Like, anyway, so that's the equivalent of that. Now, standard deviation real estate, it is 7 to 10%. Now, could be the price swing. Standard deviation would be the price swing of something that can go up or down and still could be considered normal. Did you have something to say there, Jay?
And that's the thing. Yeah, that's the thing is so home on average is going to appreciate about 5% a year long term. We already know this as an average. So standard deviation means, you know, it could, you know, 5 is the middle. So it could go up 15, right? Because 5 plus 10 on a standard deviation, or it could go down, right? So we go down 5%, right? So that's not a very risky asset. Gold is about 10%. Life insurance is 0. The stock market is much higher, right? Crypto is much higher. So what does this mean? It means if it were to drop 10%, I just need to make sure I've got that much in cash or in equity, right? The only time that matters is when the tide went down and I wasn't wearing any pants, right? Like if I wasn't covered, then yeah, that sucks. The real estate market crashes. But into the next point of view, this kind of leads into point number 6. In 2008, people are like, hey, these guys, you know, at Heloc, didn't people lose money? No, these were second positions. This means I already had a mortgage. And in addition to that mortgage, I added a line of credit on top of that. And so when the recession came, the mortgages that were HELOCs that were second position, they didn't have the primary debt. They weren't in first position, so they foreclosed. They said, we're second in line. We want our money back. We're worried that you're not going to make the payment. We want our money back. People were broke. They didn't have money. You have to realize, you know, the average American has less than $1,000 saved. So they have a $20,000 second position HELOC, and the bank all of a sudden says, hey, pay up. You got $1,000. What are you going to do? You got to give up your house now, right? So never do a second position. And then the other ones that lost were subprime mortgages, people that got mortgages that should never have got mortgages. But if you go study the 2008 crisis, it was predatory lending. It was dishonesty in the mortgage market. It was dishonesty in Wall Street with banks. So that's not who lost money. Right. I know people that had HELOCs in 2008. They didn't get their loan called. They were completely fine. Why? Because you're paying into it. Like, again, if you're a bank and you have a family that's putting 100% of their paycheck into the HELOC, right? You're looking at it like, oh, they're making $8,000 a month payments. They're de-risking you. They're deleveraging the asset. And you're going to look at that and be like, okay, that's good. I'm going to keep them on my balance sheet. You're not going to be like, I'm going to foreclose on them and keep Billy Joe, who makes $1,000 a month payment off of his pizza delivery tips, right? Sorry, Billy Joe. I was there once too. Okay. So these are the facts about the HELOC. The next thing we're going to dive into here. Oh, it looks like we might need to mute somebody. Neno, are you able to make sure everyone's on mute there? I hear some feedback.
Sure.
So the next thing we're going to dive into is how does it work, right? So step number 1, like when you're doing a HELOC, you want to get into it with 10 to 20% down, or have a home that has at least 10 to 20% equity, right? Neno, are they going to let you do a HELOC with 3% like on an FHA loan?
Yeah, 3%, yeah. With an FHA loan, yeah.
On a HELOC, they're not gonna though. And why would you think that is? Why would the bank want you to be borrowing more money?
Again, so if we think about the financial trap, easy to get in, very hard to get out, right? So if I don't know what I'm doing, right? Most people are like, hey, just maybe you are could be the exception. Like, I'm getting a house, I know what I'm doing. Like, I have all this money set aside. I know that I'm going to be paying more. This amount's going to go towards interest and then principal and so on and so forth. But most people, right? Speaking from experience growing up and also seeing working with people on a daily basis, they're just happy to get a home. Like 3%, good. Like, hey, when I look at it, right, and I just take a look what I'm paying in comparison to the rent, it may appear to be lower than my rent, right? So now to answer your question, right, why would that be? Is because, okay, good. If we're gonna be loaning this money here, now this individual has all this amounts where they own us. And if they default, we still have the property. What are they gonna do? Like, they're just be happy that they have we allowed them to have the house to begin with.
Yeah, Justin Goff here on Facebook. He has an awesome comment. Justin has a HELOC. He's a client. He says, a good friend of mine tried to tell me that the HELOC was a bad idea. I couldn't figure out why until I realized he owns 25% of the bank that held my mortgage.
Wow. Wow.
That's exactly what we're talking about. Vanessa says a little lost. Why would they be putting 8K monthly into their HELOC? So we'll jump into this in a second. So how does the HELOC work? So that you're going to have either a home that has 10 to 20% equity, or you put 10 to 20% down. Now, I had a client ask me, if I'm getting into a home, should I be buying a HELOC first? And the answer to that is it depends on the math, right? So if you're renting and you could get into a home, let's say you could do 3% on a conventional mortgage, and that actually is cheaper, then totally, it lowers your housing costs, but it actually has to be really cheaper. Now, once you built up 10 to 20% equity, you would refinance. So if someone doesn't have that 10 to 20%, and it's like, okay, well, do I put down, a $10,000 security deposit on an apartment, or do I put down 10 grand on a down payment on a home? If it truly is cheaper, principal, interest, taxes, insurance, utilities, maintenance, repairs, upgrades, Wi-Fi, all of this, lawn mowing, snow shoveling, trips to Home Depot, all of that stuff, all of that is cheaper than rent plus renter's insurance, go at it. I haven't seen it actually be cheaper most of the time though, right? So you would have a home that has the equity. Second thing is, on a HELOC, the loan is annual simple interest. So this means that it's interest only. So if I have a $100,000 HELOC and my interest rate's 4%, then my interest that I'm going to pay is $4,000 a year, right? Now, it also goes on average daily balance. Remember, it's a line of credit. So think about with your credit card, right? So if you have a credit card and you have a balance on that credit card, but every day of the month, you're reducing that balance, when it comes time for you to pay your interest, if you paid it down or paid it off, you're going to owe less interest on your statement, right? Now, if you left it outstanding, what happens? You have this giant interest payment. Same thing with the HELOC. So to answer Vanessa's question, the HELOC works like a checking account, right? So when I get my HELOC, I should be depositing all of my income into it. That's why in the example, the family's putting $8,000 a month. That's their income. That's their net income. That's reducing the average daily balance. That annual simple interest, let's say it's 4%, is being calculated on the average daily balance. So by paying that $8,000, I'm reducing that average daily balance. This 4% is calculated off of a smaller and smaller number, right? So it actually reduces the interest that way. So the HELOC becomes your checking account, receives all your income and all your deposits. Now, once you get a HELOC, and Nano, this is kind of our rule with any type of line of credit. We tell people to keep 10% in reserves, right?
That is correct, right? So again, it goes back to being just having the financial literacy aspect, being prepared. Like, might not be as easy to quote unquote get in as would be a conventional mortgage. Well, guess what? Now, once I break, because again, we're trying to break free of something, right? It's gonna take a little bit of work, right? It's very easy. Like, hey, let me go ahead and lure this individual in to a regular mortgage. Why? Because now once you're in, now I'm locked, right? We're actually trying to break free. So whenever we have this in mind, right, we got to take it into account, like the 20% down. We got to have ideally 6 months of reserves, and like have a fantastic, credit score and so on and so forth. And in addition to that, we got to have this additional 10% of reserves, right? To make sure that we're covered. Like every time we're going to be, either doing a deal or, working with something like this on top of our 6 months reserves. To why? Because things can happen. I want to make sure that I am protected, right? I got to minimize my own risk because to a degree or another, I am going to be thinking and operating like a financial institution, right? If I am not going to be doing that, I'm giving that up, that responsibility. Now is going to what? To a regular bank that I am at the effect. And we already determined they don't have our best interest in mind. But go ahead, Jerry.
Yeah, and the reason that this number is 10%, remember me and Nano said the standard deviation on primary residential real estate is 7 to 10. So that yo-yo, that upswing, that downswing, if it swings down 10%, you want to have the cash to pay your loan down, right? So then you can dump in the cash and now you're fine. There's no emergency. It's only an emergency if you don't have the money, right? So this is 10% in addition to the 6 months. So you keep 10% in reserves. Now you're going to pay all your bills and transfers with the Heloc. Your sacred account premium, you're going to pay that from your Heloc. Your groceries, you're going to pull money out of the Heloc and buy your groceries, right? So what's going to happen is at the beginning of the month, you're going to be cash heavy. You're going to dump in your deposits. It's going to reduce your average daily balance. If you want a pro tip on this, you actually would use a cashback credit card, pay all your bills on a cashback credit card. And then at the end of the month, you would take one loan from the Heloc, pay off the credit card. Why would that be? Because here you could make 2 to 4% cash back on all your transactions. And then you can leave your cash in that Heloc all month. And then on the final day of the month, you just take one loan, you pay off the credit card, boom, it's done, right? So what this does, it reduces the average daily balance like we talked about, thus reducing the interest expense. That's the beautiful thing on a Heloc. On a conventional mortgage, I can't control how many interest dollars I'm going to pay. That was predetermined. The bank went into the conventional mortgage knowing that if I keep the loan for 30 years, they already know what they're going to make. Okay. On a Heloc, they don't, because I have control. Yet you want control with your finances, right? When you have lack of control, that's when you become a victim. That's when you get taken advantage of. So I have control. What is my control point? I can put more money in the thing. And by doing so, balance goes down. Interest is calculated on balance. If balance is lower, so are interest dollars, right? And then finally, accumulating the 50K. This will happen between paying down my loans and also the property naturally appreciating. When I get 50K, what can I do at that point, Nano?
So one, you can invest. Number, before I dive into this, one of the things that you were, explain as far as keeping 10% because the price can go up and down the yo-yo. That's where the could be risky if I'm not expecting. If I know this is gonna happen and I plan ahead, now guess what? My certainty just went up, and it's not a surprise. Like, okay, that's part of the game. Like I'm prepared. Okay, okay, here you go, done. Versus like, oh my God, I got to come up with an additional 10%. I should have never done this to begin with, blah, 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 blah. I'm like, that's being like a little irresponsible, right? Like I'm jumping into something, not knowing how this thing is going to play out, right? And that's why, again, it takes what I got to understand some of these terms. I got to like, okay, how do I do this? Like, okay, you have like the discipline to be able to pay things off. Perhaps I'm, living in a place, if I'm renting, like I'm pushing away my dream to own a home, right? Because I have something like senior that I'm trying to accomplish, which is going to be financial freedom. Now, let's say now going back to this other question that you mentioned, once I do accumulate this money, 50,000 between appreciation and principal reduction, guess what? Time to play ball, right? Now I take this money out. Now I'm going to put in an investment. Now this investment ideally is going to be producing passive income for me. And we have this money flow right back into the home equity line of credit, which eventually is going to be in a position to even take care of my mortgage payment or of my payments. Were you going to say something, Jerry?
And that's a beautiful thing, guys. This is where your income covers your housing costs. I have a client, he might even be watching this. He doesn't have a housing payment anymore. We did a HELOC with him. His income from his interest is greater than the mortgage payment. His housing payment gone, right? Because it's just covered, right? So here's what you want to look at with this. There is timing with this, right? So Nano said, we want to have our reserves built up, right? This is not the first thing we're borrowing against, by the way. First, we're going to learn to borrow against life insurance. Why? Because it can't lose. right? Like you're going to add a gradient. You're going to do it gradually. I'm going to borrow first against life insurance. That's what banks do. They do life insurance. 20% of their tier one capital is in life insurance, more than they actually own in real estate, right? So I'm borrowing against life insurance. I'm learning how to be my own bank there. It's totally safe. Nothing bad can happen. Next thing is gold. Why? Because I can do that in smaller denominations. That's also a tier one asset. The final one I do is the Heloc. Why? Because I live there. Right? With life insurance, if I don't pay my loan, like I just have the interest going out, it comes out of my cash value, I'm fine. With gold, if there's a correction, I just sell some gold. Okay. With a Heloc, if I mess up, I'm homeless. Right? So we're playing high stakes ball here. This is not the first thing we jump into. We get clients all the time that want to skip to this. And I understand why, because people have homes, they have equity. They're like, man, I'm ready to do this now. No, you're not ready. You just want to. There's literacy that needs to come first. If you just learned about this, the next logical conclusion is not, I'm going to go do it. Right? Like if you just became aware of this as a concept, the next logical conclusion is I'm going to learn the theory. Then I'm going to practice. I'm going to do the practical. I'm going to drill it.
With less
I'm going to do it
risk.
on smaller things before I jump into it. Go ahead, Nano.
No, I say with less risk.
Yeah, drill it with less risk. You don't want to be drilling it. Like Nano, you watch UFC. They practice with soft gloves on. They don't do like it's not as bad as the actual match, right?
Totally. Whenever I was when watching a couple of things, or whenever they're in a practice, they're never really going like full. They cannot strike like, otherwise they start getting cuts, right? Unless they're doing some sparring, which somewhat similar to the real deal, but it's not like the real deal. Why? Because they can actually get some real damage. And now a person may see this, and you and I have seen this in the past, right, Jerry? They're totally going to bypass, what we say here.
Doesn't matter what you say. Yeah.
And they're going to try to do this on their own. And next thing you know, right, could be, in a problem. Like, hey, like, oh, this wasn't like really what I thought it was. Or now they're finding themselves like super stressed out, trying to figure things out, right? So again, it's kind of like saying, like, in the beginning of the book, it says right here, look, here's the game plan, right? Could I build a house if I have a blueprint and the tools all by myself? Sure, I could. But what about if I were to have a team that knows what they're doing, have all the tools and the right people to do the right steps along the way? Which one would be best?
Here's the thing on that, right? So we have this thing called the blueprint, and this is an actual strategy. This is based on what the top 1% have actually done. So for clients, if they're following the blueprint, we're following the blueprint. If you ain't, you ain't, right? Like you're either in this thing or you're out of this thing. So like when we're working with clients, sometimes we'll get people that are like, I want to skip to the Heloc. I want to skip to the Heloc. Just from the standpoint of you've hired me to help you with your finances. One of my first prerequisites is, are you coachable? When I give you instructions, do you follow them? Right? Do you listen? Do you do things in the right order? If you don't, like, that's not a successful thing. That like, yeah, cool, you got the Heloc, but what, like, you're skipping the entire prior steps, right? You don't know what happens after. Like Nano said, there can be risk, but even more senior to that, like finances are just math. You can't figure out math if you skip through the equation. You have to understand each number in there, and you've got to do it in the right sequence, right? We call it a blueprint because it's like building a house. This is the equivalent of saying, hey, I like roofs, so I'm going to go ahead and put the roof on before the walls are done. Doesn't make sense. It doesn't matter how much, like, I like windows. Before I've put a foundation, I'm going to start just putting windows in. Like, no, you need to do the things that happen first, not just skip, right? So here's an example. This is an example of someone, they've got $350,000 home that they're going to do. They're buying, right? So let's say they put 10% down. So that's 35 grand. They're going to finance the balance at 315,000. I went a little bit high on the interest rate at 5% interest only, right? So their maximum monthly payment, meaning if they never paid anything down on the Heloc, their maximum monthly payment would be $1,300. Okay. Now, if you do the math on this, that's much cheaper even at that rate than a normal mortgage would be. But if you get a $315,000 home, your mortgage payment's not going to be $1,300, right? Now, if we're doing the deposits, like I was saying earlier, you're reducing that balance. It's actually going to be much lower than 1312. It's probably going to be, half of that. Now, what we're looking at is here, let's say this family earns $10,000 a month in income. They deposit all of that into the account. Like I said before, it reduces the average daily balance. It reduces the interest dollars paid. And then at 50,000, they borrow that 50 grand back out. They're going to take this 50 and they're going to invest that in a private lending deal at 12%. right? So their interest expense is about 2 to 3 because we're paying it down. So it's gross 5, we're reducing it. So the actual interest cost is only going to be like 2 to 3%, right? They're going to be bringing in, 12% on 50,000, that's $500 a month. So they're making a positive spread there. Okay, now this is how you turn your home into a passive income source. This is not Airbnb or you've got some stranger sleeping in your spare bedroom, right? This isn't trusted housekeepers. This isn't any of those things. This is you turning your mortgage into a source of passive income, and it takes none of your time, right? So we've had clients do this over and over and over, and this is a strategy that's been around for a long time. The reason why most people don't hear about this is because it's less profitable. Like Justin said, his friend told him, hey, you shouldn't do a HELOC. Well, it turned out the friend owned the bank, right? I've heard stories of people going into the bank and the banker saying, hey, we can sell you a HELOC. We're not going to because we don't make enough money to do it. Sorry, you've got to do a conventional mortgage, right? When banks borrow money, banks don't borrow money on amortized loans. They do interest-only lines of credit. So you're looking at, I want to be the bank. Well, it starts with, when I borrow money like the bank does as well. Okay. Now, every few years, the home's going to appreciate, right? So if I put in 350,000, I buy a home and that appreciation rate is 5%. Okay. After 10 years, that 350 grand is going to grow to almost $600,000. Okay. Neno, what are you thinking at this point? What are you going to do with that extra money?
Well, we got to put it to work.
Exactly.
Right. Well, I
So
mean,
here's where we refinance. And this is different.
Which kind of goes back to like, I gotta have, what is the primary thing? What am I trying to accomplish? Right. Because if my ideal scenario, right, it's like I'm gonna be like having this romance towards the idea of having like the house paid off, and it's gonna be my house and whatnot. I'm like, okay, that's fine, right? But try not paying, property taxes and see who actually, what happens, right? Like, so it doesn't even actually get to the point that I actually fully own the house, right? But on the flip side of the coin is like, okay, if I do this scenario here, right, and I have passive income that's paying me on a monthly basis, then like whenever I don't want to work anymore, all good, right? Because I have now income. I have like literally, I did the strategy correctly all throughout this couple of years. And because I did that, because I decided to not follow the conventional route to do like the thing that maybe was a little bit more inconvenient. Now, when you think about this, what would be the inconvenience? Making sure that I'm financially literate. Now, what's the alternative? Be a prisoner for life. This is assuming I'm still healthy and be able to work. What if things happens, right? Which things happen in life, right? So to answer your question, what can be done? I can take this money out. I can put it to work. It's also like, okay, good. I am literally buying my time back. I'm getting my financial freedom back.
Yeah, and to further reduce Nano's point down even more simple, like he said, it's inconvenient to be financially literate, like to study and learn about money. Well, the alternative is to be dumb, right? Literally to be a financial dumbass, right? And that's pretty inconvenient. I've been one before. It's not fun. It's expensive. It's more inconvenient than spending an hour a day studying. We're not even saying do an hour a day. We usually say 10 to 30 minutes, right? So here's a couple questions that came in. Justin asks on Facebook, HELOCs are only for a 5-year term, correct? So most of them are going to be 10 years. 10 years, you'll see some that are 15, some that are 20. So it can vary. I'm sure there probably are some that are 5. There are some that have intro periods of lower interest and they step up. So all of them are going to be a little bit different. You have to remember that they're being offered by regional banks. So it's not uniform. Every bank is going to have their own parameters. Nick Bracey asks, can you refinance a HELOC? Absolutely. Right. So when you refinance a HELOC, you can do that really at any point. And at the point you're refinancing, you're either going to do that because the interest rate has come down or you've got a significant amount of equity and you could refinance and get that money back out. Right. So if a HELOC is a 10-year term, that also does mean every 10 years, you're automatically going to want to refinance because that HELOC ends. Now I need to reset it. Right. So those are the refinance questions. This is different though than a conventional mortgage. Remember when I said on a conventional mortgage, you're resetting your amortization. You're paying a little bit of principal, a little bit of interest, mostly interest, very little principal. And as you go down and progress, your principal is higher, the interest is less. And then you refinance, boom, you're back at the top. You're paying a bunch of interest again. A HELOC doesn't amortize. So when you refinance, you're not having that reset. It's how much equity did I put in, right? How much income am I depositing? And then how much passive income am I getting from this? Okay, so those are a couple questions answered. We've got a question from Avery. Let's actually take a break really quick, Nano, and answer some questions.
Sure. There's quite a few questions here.
All right, so let's bring Avery on live here for his question. Hey, what's up, Avery?
Hey, Jerry, Nano, what's up, fellas?
What's going on,
Hey,
man?
good to talk to you. What's your question?
Yeah, so there was a post I remember you creating earlier in the year about the Heloc partners and the banks tightening some things around the first position Helocs. I believe, depending on the state, a family had to go into a conventional mortgage first, pay it down to about 80-90% loan to value ratio, and then refi into a Heloc. Are you aware of which particular states are doing that at this time?
Yeah, so most of the states, I think they're starting to loosen up again. A lot of that was the COVID, restrictions and the moratoriums on foreclosures. So, if you're in states like I think Hawaii is a difficult one, Texas is pretty tight on HELOCs, Alaska is pretty tight on doing HELOCs. There's certain states like that. I know you're down here in Florida part time, and I think in Colorado, so I think you're okay with that. Florida is like the wild, wild west with HELOC. So if you're going to get a HELOC, Florida is the place to do it. I think that Colorado is also fine. Now, if you were going to do a conventional, like I said, that's not necessarily a bad thing for somebody that doesn't own a home yet. If they're doing a conventional, at least they are doing principal reduction. So if they can't come to the table with, because you can't borrow, or you can borrow, you don't want to borrow until you have 50, like free. So even if you put 10% down, you're not going to be able to borrow anything yet, right? So there is an argument of, okay, well, do I put 10% down on a conventional and maybe do a 30 or a 15 and then let the amortization pay it down a little bit and then I refinance later? And that's something you could look at. You don't have to do it that way. Some banks will require it, but there are more and more banks that are opening things back up again. Awesome. Good question there from Avery. Let's see if we have any other questions that have come in that we haven't answered yet. So again, if you guys have questions, drop those in the chat. And again, if you haven't reached out to Kevin and Griffin in the comments, make sure you do so. Okay, question from Jamie here. Let me bring Jamie on live. All right, let's see if we can mic up with Jamie. If not, I'll just read Jamie's question. Okay, I don't see that Jamie has a mic. So let me go ahead and read Jamie's question. If your home is paid off, would it be better for you to sell your home to an LLC that you set up to hold your mortgage for the LLC? You'll need to pay rent to the LLC. The LLC is able to depreciate the property and any expenses are tax deductible. You personally wouldn't give this, you personally, you wouldn't just give you a bigger tax benefit versus doing a HELOC. Okay, so if you sell a home to an LLC, you're looked at as the same entity, right? It's going to go on your tax return. So you have to sell it to a corporation. If you do an S corporation, you can do depreciation and different things. You still could also do a HELOC, Jamie. So you could sell it to the corporation and then have the corporation do a HELOC or vice versa. It can't be just a standard LLC though, just because that's going to be the same as you as far as the IRS is concerned. Okay, Jaron has a question. If you have an actually, let me see if I can bring Jaron on live and answer his question. All right, let's see if we can mic up with Jaron here. Hey, Jaron, how are you tonight?
I'm good. And yourself?
Hey, I'm good. Thanks for asking. What's your question?
My question basically is, if you already have an investment property, you have 6 months of savings saved up, right? I basically have an investment property with no mortgage. When is it, what's the question? When can you start investing with the equity in the investment property? What is the requirement as far as sacred account? Because I don't see, I guess, the connection between the sacred, I mean, I guess I get the connection with the sacred account light where you're saving up the 5 months in there. But is the requirement of getting the premium before you can do investments with the HELOC? Because there is a 2-month gap before you can get the premium, is my understanding, or at least that's been the experience with the light.
Yeah, good question. So basically, Jaren's asking when you do the HELOC, like what on the blueprint specifically, right? So if you've not read the blueprint book, it's going to be in here. We do the HELOC on phase 2C, right? So that means everything prior to 2C, we want to have that done and taken care of. So the logic here is this: we want to have our debts handled, right? I'll just kind of sketch this out, right? So we want to have, obviously, the very first thing is we want to have financial literacy. Okay, so we want to understand finances. Now, this is not a one and done thing. Financial literacy is something that we continually build on, right? So financial literacy, and specifically in the areas of lending and HELOCs, right? So what are we going to do with the HELOC? We're going to borrow against it, right? When we borrow against it, do we want that to be our first private lending deal? Probably not, right? Do we want to understand how HELOCs work? Definitely. Do we want to understand how interest rates work and all these different things play into it? Definitely. So there's financial literacy. We want to be earning more than we spend. Okay, so that's the next thing here. We want to already be on a forced savings plan. If we don't have forced savings happening, a HELOC is actually going to be detrimental, because the requirement would be for this math to work, we have to be depositing income. If I've never saved money before, it's not a smart idea for me to go into a system where I've got an interest-only mortgage with the expectation I'm supposed to pay it down to take deposits out, right? So forced savings. I also want to be investing in real assets. A HELOC is based on the premise of investing in real estate, right? So a real estate is a real asset. And so we want to already be doing that. Life insurance, gold and silver, things of that nature. We don't want to be just putting everything in the bank account. Okay. So the other thing here, then we handle our credit. Any credit and debt issues, right? So this is going to directly play into our ability to get good rates, get good offers, et cetera, with the HELOC. So we do credit and debt. Then we build 6-month reserves. Okay. And again, we want to have 6-month reserves in our sacred account. We use life insurance for this. And this is not even involved with the HELOC. This is just the point of being solvent, right? If I have 6 months in reserves, I'm solvent. Once we have 6 months in reserves, we want to be properly protected next. All of our liabilities and risks are covered. I have my insurances. I've got my LLCs. I've got my entities. I've got my estate plans. All of this stuff is there before I start inviting risk-adjusted assets. Right? So everything prior to step 7, there's no risk involved. There's no risk with life insurance. There's no risk with learning. There's no risk with buying stores of value, right? When I start getting into things like gold and HELOCs and all this stuff, there's definitely risk there. And I want to make sure I'm protected. Now, part of this is, okay, here with this and this, we do the sacred account light. Sacred account light is high early cash value, dividend paying whole life insurance. We design it on a 10-page structure. It's specifically designed for handling debt, right? And so once someone has gotten rid of their consumer debt, that's taken care of. We then build up our 6-month reserves. Okay, now what we do here is called the sacred account premium. This is part of 6-month reserves properly protected and then getting into investments as well. Sacred account premium is a different design entirely. Right. So this is going to be a higher charge growth. There's going to be more riders. There's going to be higher contributions. And the reason there's a difference here is usually by the time we've gone through this, we've freed up a lot of cash too. Someone starts on their light and it's like, okay, you're doing $250 a month. You're doing $500 a month. Well, we just freed up maybe, by getting someone out of debt and all these things, freed up maybe $500 or $1,000. Where's that money going? Right. So the sacred account premium is going to be included with that. The other thing is going to be the long-term care rider. Right. So a long-term care rider is going to cover you on properly protected. And that's part of your estate planning and basically covering your bases prior to getting into the HELOC. Right now, once we get into the next step here, this is where we start doing gold, right? We're actually going to borrow against gold. We're doing gold loans. This is a smaller denomination than a home, right? So I'm borrowing against gold. I can buy 50,000 or 70,000 or 100,000. I want to practice on that before I'm like, hey, I'm going to do a $300,000 loan against my property, right? So that's kind of the gradient here. Go ahead, Neno.
And less risky too in comparison to the HELOC.
For sure, less risky as well. I've got a lot more control over this. And then we get here into the HELOC, right? So the HELOC happens after this, and it also happens right before we do tax planning. The reason why is we don't want to reduce your income on your taxes and then have you go to a bank and say, hey, I have zero taxable income. Can I have a loan? They're going to say, no, you're broke, right? So the sacred account premium specifically is we're increasing the savings rate. We're adding in the extra riders. We're covering the protection side of things. And so most of our clients, they're going to end up with 2 sacred accounts. They're going to have their light, they're going to have their premium. Okay. And then with this being said, we've got these set up. We've got everything else here covered. These are done. We're doing gold loans now. And then once we've done this, we start then getting into, okay, let's do the HELOC. Let's do the tax planning. If I could continue down the list over here on phase 3 is where we start heavily getting into private lending, right? Now, the other thing that can happen is sometimes on tax planning, we might say, hey, let's have you go buy some turnkey rental properties so you can get accelerated depreciation on those to reduce taxes. More of a tax play than an investing play, really, but we could put HELOCs on those too, right? And then the thing that we're looking at is every time we do a line of credit, we've got a gold loan, we now need to have an additional 10% in reserves. If I don't have extra room in my sacred accounts, I don't have anywhere to put that money other than leaving it in the bank. And the whole point of this is not to be giving the bank my money, right? So if I do a gold loan for 100 grand, I need to have 10K extra in reserves. If I do a HELOC for 300,000, that's another 30K in reserves that I want to have, right? So that's part of this is if you're doing a sacred account light, your MEC limit is lower. And you're not going to be able to put all this money in there, plus your 6-month reserves, plus the extra income. Like you're going to cap that thing out really quick. So then it's okay. I need to open up the next one. And the next one is not focused on debt. It's a different structure. And so we can actually take advantage of that to get you more growth long-term. So I know that's kind of a bunny trail, but I know that's a question Jaron's had. And so I hope that that helps kind of answer that. Good. Let's jump into a couple more questions here. Nicholas asks, does the light and the premium have to be on the same person? Not necessarily. You can insure different people. That's a good question. Good here. I see a few more questions here that just came in. William asked, does Hawaii do first position HELOCs? Yes, they do. Most banks will do primary and investment. Yeah. Good. Andre has a good question. Let me bring Andre on. Hey, what's up, Andre?
Hey, what's up, guys?
Hey, what's your question?
Yeah, so, just being used to doing the sacred account goal and sacred account with life insurance and maxing those out. Now we're introducing the HELOC. I wanted to kind of get your feedback on the flow of using the HELOC, and also, of course, still contributing to purchasing bullion and putting it in the life insurance policies as well, so we can kind of maximize everything as much as possible.
Yeah, that's a great question. So basically, like when you're, so the big rule here, Andre, is obviously at that point, you're doing like 40% savings or higher. So you've got 3 stores of value now. You've got your life insurance, you've got your gold, and then you've got your HELOC, right? So you have your life insurance kind of at a fixed premium. You already know the dollar amount per year or per month that's going to be. Gold can be whatever you want it to be. And then the HELOC payment, the reduction of principal, that also can be whatever you want it to be. So if you take the pie of 40%, you can kind of look at, okay, what percentage of this do I want to have going towards life insurance? What percentage do I want to have going towards gold purchasing? And then what percentage do I want to have going towards real estate or towards the HELOC pay down? And so you could say, I'm going to put, 15% in life insurance. I'm going to put 15% in gold, and I'm going to put the rest, the other 10% towards principal reduction on my HELOC, right? Or you could chop that up however you want to. For me personally, like I look at it kind of like this. I would rather go heavier on the gold and the life insurance because I'm adding more. The HELOC, I'm not adding more. I'm just reducing what's already there. So it's not expansion per se. I'm not buying more things. I'm just paying down an existing loan on an asset that I already have. So it's kind of the equivalent of like paying down my life insurance loan. I don't not want to do it, but if I could buy gold instead or put more in paid up additions, I'm going to do that instead. Right. So that's kind of the thought there. So I hope that kind of makes sense. And then when you get your passive income from your loans, you borrow against the HELOC. all of the income from that should stay in the HELOC, right? So if I borrow 50,000 out, I'm getting 500 a month, just like with a policy loan. That 500 services that loan specifically, and I leave that in there, right? So that's another factor to kind of look at. Good questions. Let's see. Doug asks, what separates wealth dynamics from the competition? Doug, that is for you to decide, my friend. Good questions. Good. So let's jump into Facebook chat real quick. We do have a few more that came up here. Justin Goff asks, are HELOCs all variable rate? So you can go variable or fixed, right? So variable, you look at, you know, potential for up or down movement. Usually that's going to start at a lower rate. It could go up if rates go up. Fixed, it's going to be a higher rate guaranteed, right? So you're going to have a higher rate to start, but if interest rates were to climb, you're not going to experience that climb. You're fixed, right? So you could do both. Generally speaking, you know, most people do go with variable, especially if you're paying down that HELOC over time. We have a success story from a client, Jason Crockett. He said, doing this strategy now, the HELOC, thanks to Jerry, reduced our monthly housing payment by $1,800 a month, investing the equity in the home. Monthly savings goes into the sacred account. Awesome stuff. That is awesome. I love hearing successes like that. Let's see here. Good. So we're going to answer a couple more questions and then we'll jump into the final parts of the slide here. And guys, again, if you've not connected yet with Kevin or Griffin, reach out to them in the chat. Again, they want to set up a call with you. If you don't have the book, Blueprint to Financial Freedom, okay, you can get a copy of this. You can get the ebook. It's $2.99. You can get the paperback free. It's $10 for shipping. We'll send it out to you. This does come with a free coaching call, right? So if you want to do a coaching call, you know, connect with Neno, connect with Nick, connect with Kevin. They'll all be able to help you out with that. Nano, let's jump into our last couple slides here. We've had a bunch of questions coming in, which is great, but I want to get this finished up for everybody. So we kind of already hit this one, right? The phases. So we're looking at reducing our housing costs. We're increasing our savings rates. We're freeing up cash flow. We're reducing the payments further with the deposits going in, that interest goes down. And then we do our first investment, right? Now, after about 2 to 3 of these investments, usually that's enough income where our mortgage payments covered, the interest expense is totally covered. And then this gets into what Andre was asking, saving 40% of income, right? So we've got the HELOC investments pumping out. The idea is between, and this is the magic equation, right, Nano, between the sacred account, you know, life insurance, gold, and real estate, we've been borrowing against these to achieve passive income that exceeds savings, expenses, and taxes. What's the significance of that, Nano?
Now, you know, once I have done this, right, now financial freedom, right? That's really the bottom line. And I got to have that very clear for myself, right? I mean, it's almost like we had somebody asking here, what is the, you know, the difference between us and everybody else? So like, for one, is for the person to decide, but also you got to ask yourself the question, who is actually is putting the laid out plan step by step with just giving away the information like this to everybody, right? Like to the point, like, hey, how about like, let's just go ahead and help you on the gradient, making sure that you understand each step along the way. Hey, let's not do something because we say so. Here's the information. Let's make sure that you understand. Does it make sense? Good. Let's take some action. Here's the next thing. Here's some information. Makes sense? Good. Let's take some action. Putting you at cause, right? Because if I'm not a cause, guess what? At any given point, I could, like if I come across a financial institution that could be not have my best interest in mind, it could literally be detrimental. If I don't know how to protect myself, right? Legally, taxes, like having a trust, probate, right? Like just like those terms, if I don't understand that, that's a problem. Right? It's a problem if I want to become financially free, right? It's also a problem because to that degree or another, I don't have the literacy in that aspect. And if there's something that I don't know, like it puts me like, it's not a good position to be in because I'm at the mercy, right? So at the end of the day, like once we accomplish this, right? Enough passive income greater than saving expenses and taxes, you're free, financially speaking. Now I'm actually able to do the things that I really want to do. Right? But throughout this process, I have to have what? All those steps in place, have the inconvenience to study, have the inconvenience to be disciplined, have all that in place, right? Or the flip side of the coin, right? Don't do that, right? Just do the conventional thing. And the conventional thing is 80% of America has $1,000, right? Living paycheck to paycheck. That's the conventional thing. So either that or the opposite side of the coin.
Exactly. Now here's the action plan on this, guys. And I kind of already sketched this out, but these are the things you would do before you do a HELOC, right? So we're not in the business of telling someone, hey, you know, we'll sell you this product and this is the silver bullet product. There isn't a silver bullet financial product. Okay. There's basic math. The reality, you probably don't need any of this stuff. You'd be fine. You can earn, save, and invest, and that would work for you. Right now, if you want to supplement and if you want to enhance your progress, yeah, these can help. Right. But for us to say, hey, the HELOC is the magic thing, it's like saying, you know, you're cooking a meal and one ingredient is the keynote. No, if you don't have the rest of them, it doesn't work. Right. We're saying, hey, the life insurance, this is the thing you need to put money in because it's what the wealthy do. It's one of the things you'll do. There's a lot of things you're going to do, or, you know, buy real estate, you know, I'm fixated on that. That's the magic thing. No, that's maybe something that could work for you, but there's other things you've got to do too. So these are all the things. Become financially literate, right? Invest the time to study. The wealthiest people that I've studied, they put time in their young years even to learn about money and learn about finances. It's not too late. If you're older, you've got your whole life ahead of you to learn this stuff. Most people never learn it, right? So spend the time doing that, earning more than you spend, right? Like if you've got to earn, if you don't have enough income, you can't do a lot of this stuff. Right? So earn more than you spend, commit to a forced savings plan, saving in real assets, invest or handling your consumer debt and credit, building reserves, properly protected, become accustomed to borrowing against less risky assets, and then finally doing the HELOC. We make sure we do this before tax planning. Like this is the recipe, right? And so we follow the recipe, we go through it, and this is where you start. So you'd look at, okay, probably everybody watching to some degree or another, starting point is going to be this, right? What do I need to know? What do I need to learn? What do I need to study right now to get more knowledge on this? All of us can earn more, right? And here's the thing is like the HELOC is not magic. Like I said, you're just borrowing against the house. Your house is not an income source. So sure, it can accelerate you and it's a good thing and it's a great tool, but you know what accelerates you even faster? Increasing your active income. Right? If you show me one guy that can earn unlimited active income because of his skill set and his discipline and determination, and you show me another guy that's got a HELOC, the guy with the income is going to win. Okay, 10 times out of 10, because he can go earn whatever he wants to. With the HELOC, you're always going to be fixed. It doesn't change that, right? If you're not saving, a HELOC can't help you. If you're investing in invisible digital paper assets, like the HELOC can't really help you. You can lose so much of your money instantly. If you've got a bunch of consumer debt, you may not even be able to get a HELOC. Banks are going to look at you as a risk, right? If you don't have reserves, HELOC's not a good idea. If you're not properly protected, HELOC's not a good idea. If you've not borrowed against other assets, a HELOC's not a good idea for you, right? So this is where we would tell you to start. So if you're watching this tonight and you're like, okay, cool. Like I see this makes sense. What do I do next? The next thing for you to do is reach out to our team. So again, if you've not yet connected with Kevin, if you've not yet connected with Griffin, if you've not yet gotten a copy of Blueprint to Financial Freedom so that you can start studying and learning about this stuff, definitely do that. I'm going to check for any last questions. Neno, did you have anything you want to say before we wrap up?
No, I just see a couple of comments here, you know, from Nick. He says there's no competition to wealth dynamics. And Mark,
I love that. Thank you, Nick.
Yeah, Mark said in response to Doug's question, I have been saving and investing for over 30 years. There's no one else that has ever laid out a blueprint like Jerry has. I wish I had this 30 years ago. Would have saved me a lot of time and money.
We just had another success coming from Jason. He said, we've doubled our net worth in 5 years with Wealth Dynamics versus the previous 20 years with Wall Street just treading water. The blueprint works. Yeah. And guys, just like just to get rid of any mystery, the blueprint, I didn't come up with this. Right. I studied for years the top 1%. I studied JP Morgan and John Rockefeller and Andrew Carnegie and all these giant banks and corporations. I looked at what do they actually do? Like, what do they actually do? Because we can hear the gurus say all the time, you go buy rental properties. The wealthiest guy I know owns no rental properties. So what do I do with that? Right. So I have to look at, okay, well, what are the wealthy actually doing? And so when I started doing that, guess what I did is I did a bunch of things. I put my hands in a bunch of different areas and I just got confused and messy and disorganized. right? It's like if you're cooking a meal and you have all the ingredients, there's a sequence. You don't throw it all in the bowl at once and hope it turns out right. Okay. So what the blueprint is we just said, well, we already know what all the tools are. What's the right order? What's the right sequence? Right? That's what the blueprint is. Just like with a house, I can give you all the materials. If you don't know what sequence to put them in, you can't build a house. Right? That's why it's called a blueprint. So we follow the blueprint because that is the correct sequence. And so that's the most complete. It's a combination of most complete, most workable, and fastest. Right? Most complete, most workable, and fastest. We're not trying to go just for fastest, but it's not complete and workable. We're not trying to go for complete and it's not fast and it's not workable. We're not trying to go for workable and it's not complete and it's not fast. We need all three of those points balanced out. So that's all the blueprint really is. So if you've not read that, definitely grab a copy. Neno, we have Money Monday coming up too, right?
That's right. And we are going to be covering this book right here. Right? It is The Legend of the Monk and the Merchant. And this is like to continue adding, right? Like what is the proper mindset? Because here we're talking about, or in this particular book, right, we're going to be talking about what is the required mindset in order to like lay it out with principles. Because if I don't have the proper mindset, it may lead me to like not take action, right? That could be a mindset. Like, look, I actually have to, once I get a piece of information, it either makes sense or it doesn't. If it makes sense, I have to take time out of the equation. Why am I going to be adding time? That is an illogical behavior, right? So makes sense or it doesn't. If it doesn't make sense, then it is not for me. Let me stop thinking about it. Or if it doesn't make sense, maybe I need more data in order to make sense. Like it's very straightforward. So the bottom line is a Money Monday is going to be coming and we're going to be addressing the proper mindset in order to actually be able to move faster along the process.
Awesome. So make sure you tune in for that. That's 4 p.m. Eastern time on Monday. And again, guys, if you've not connected with our team, definitely do so. The reason why we do these webinars is to help you. So if you have questions, take it offline with the webinar, connect with Kevin, connect with Griffin, connect with Nano, and make sure you do get your questions answered. We will wrap up here for tonight. What I'm going to do here is I'm going to leave the meeting room open and I'm going to put Kevin and Griffin in charge of it. So if you guys want to stay in here, you still want to connect, ask questions, get on a call with them, that type of thing. We'll leave this open and we'll tune out. And otherwise, we'll see you guys next Friday. And then we'll see you on Monday.
All right. See ya.
Hello, can everyone hear me?
Yes, we can hear you, Kev.
Nice, nice. So I saw we had some new attendees here this evening. Are any of them still present? Griffin and I would definitely like to help you with your next steps. So what we normally do after these webinars is we like to reach out to schedule like a live coaching call to, help you, with whatever you need to direct you on what would be the next step to help you out with.
So the majority of people, Kev, I don't think they have the ability to speak using a microphone. So
okay, no worries.
You may need to ask them to either type it up so we can actually get in comm with them, just as an FYI.
Yeah, no problem. So anyone who's remaining, just from what I said, if you want to just directly message me and then I can, reach out to you through that and we can, schedule just a coaching call with me and Griffin afterwards.
Kevin, if you want to, you could drop your number or email in the chat or both. Perhaps they could reach you there, text, phone call, email, direct to you. And we, if you're working Saturday, maybe do a call on Saturday if it's convenient for them, or Monday if that works better.
Yeah, totally. Totally. For everyone that's still present, on Saturday I can do a call out to you. I have no, I can definitely reach you if that works better. Otherwise, for sure, at the beginning of the week, I'll put my number in the general chat to everyone. And this is my number you can reach me at. And I definitely would like to look forward to doing a call with everyone that's still present.
Awesome. And for anyone still here, if you had any interest at all in seeing the Sacred account, looks like a lot of you, some of these names look familiar. Some of them are new looking. If you don't have a Sacred account and you're interested, or you just want to know like the basic blueprint to financial freedom, definitely something we can just get you. It's like $3 to get the ebook. And Kevin's got his number. He just threw it in the chat. So if you wanted to text him, call him, he'll be happy to set up a call with you and get you the information on the blueprint to financial freedom and the Sacred account, just getting you introduced to that, why you would want to fit it into your portfolio or whatever you've got going on.
Definitely. Yeah, just like was mentioned at the webinar, we, Jerry has the blueprint. He's written a book. It will give you the exact steps. That's to give you like a kind of a path that you need to just follow, just step by step, that will take you to the point you're actually wanting to reach financially. So we can help you achieve that. So Griffin and I, we're here to help.
Well, thanks a lot.
All right.
And it looks like, I don't think we have any other questions. Any other questions? I don't think we see any. If not, then good talking to Kevin. I'll look forward to talking to you tomorrow.
Yeah, definitely, Griffin. And everyone else that's still present, thank you for attending the webinar, and we look forward to hearing from you.
Awesome. Have a great night, everybody.
Have a great night.
Have a great night.